Let's cut through the noise. You're here because you've heard the phrase smart money concepts. Maybe you saw a video. Maybe someone flashed an insane win on Instagram with a few boxes and lines on their chart saying they trade like the banks. Now you're curious, maybe a little skeptical, maybe even desperate. Because let's be honest, your results haven't matched your effort. You've studied, you've watched hours of content, you've learned patterns, structure, indicators, and price action. But the market still feels like it's out to get you. Like every time you enter, it turns around and punishes you. You're not alone. That exact feeling of doing everything right and still losing, that's what drives thousands of traders to smart money concepts. But here's the brutal truth no one is telling you. Most people who claim to trade like the banks, they're just following other retail traders pretending to trade like the banks. They're copying boxes and calling it mastery. They're reacting emotionally and calling it discipline. But smart money concepts isn't a set of lines or zones. It's a way of thinking. It's a psychological lens through which you see the market, not just as price, but as human behavior visualized. It's about understanding how institutions think, how they hunt liquidity, how they trap emotion, and how they position themselves when the rest of the market is panicking or euphoric. And that's what this video is all about. Not just the mechanics, but the mindset. Not just the how, but the why. Because if you don't understand the psychology of smart money, if you're just following setups without understanding the emotional fuel behind each move, you're not trading like the banks. You're trading like bait. This isn't going to be some surface-level tutorial with a quick markup and a flexed MT4 account. This is a full deep dive, broken into 6 focused chapters on what it really means to think, act, and trade like smart money. We're going to strip back the layers. We'll talk about manipulation, emotional liquidity, patience, precision, discipline, and how the market reflects your deepest psychological patterns. And by the end of this journey, you won't just see price differently. You'll see yourself differently. So if you're ready to step away from retail thinking, if you're done chasing candles and want to start anticipating moves with real confidence, if you're ready to face the uncomfortable truth of your trading psychology and rebuild yourself into something sharper, calmer, and more dangerous, then hit that subscribe button right now. And while you're at it, like this video. It tells the algorithm this kind of no BS content matters. Oh, and drop a comment below. Let me know where you are on your journey. What's been your biggest frustration with smart money? What's the one concept you just can't seem to master? I read every single one. Let's build a community of traders who actually want to grow and aren't afraid to face the truth head on. All right, take a breath, clear your screen, because it's time to find out. Are you really trading like the banks? Let's begin. Chapter 1. The Illusion of Trading Like the Banks. You wake up, check the charts, and feel the rush. Another day in the market, another shot at that elusive win. You tell yourself, today's different. Today, you're going to trade like the banks. But are you? Let's be honest for a moment. No filters, no fluff. You're chasing smart money. You're watching price sweep a high and thinking, that's liquidity being grabbed. That's the banks loading up. I'm on their side now. But do you really understand what that means? Do you really know how the banks operate? Or are you copying surface-level patterns from an influencer's YouTube video and calling it institutional trading? Here's the truth you don't want to hear. Most people who think they're trading like the banks are actually doing the exact opposite. They're hunting liquidity, yes, but it's their liquidity being hunted. The banks are feeding off you. You're the retail trader who screams smart money concept every time a market structure shift occurs, but you don't understand the deeper psychology behind it. You're not manipulating markets, you're being manipulated. Let that sink in. You've probably heard the terms order blocks, liquidity grabs, mitigation, displacement. internal range liquidity, market structure breaks. But do you know the why behind those moves? Because banks don't place trades for fun. They don't look for symmetrical flags and head and shoulders patterns. They look for inefficiencies. They look for trapped traders. They look for you. Yes, you. They need you to take the bait. That false breakout, that was crafted to trap your FOMO. That perfect order block, it's where you stacked your risk just before getting stopped out. And that aggressive move right after your stop loss gets triggered, that was your liquidity harvested. You think you're following smart money, but most of the time you're reacting, you're chasing, you're emotional. And the banks love that because they're not hunting price, they're hunting behavior. They're watching the mass psychology unfold in real time. They know when you feel confident, and they know when you're scared. They know you can't resist buying the breakout after 3 green candles, and they know exactly where your stop is, because it's where everyone's stop is. The banks don't play fair. They don't have to. They're not following some Instagram trader's markup. They're reading the order flow. They're watching the collective retail emotion like a predator watches prey. And they don't need to be right all the time. They just need to be on the right side of your mistake. So if you're really serious about trading like the banks, it's time to flip the script. Stop thinking in terms of chart patterns and start thinking in terms of human behavior. Stop obsessing over price and start mastering psychology. Because here's the truth most people won't tell you. You can't outtrade the market until you outthink yourself. And right now, you're your own worst enemy. It's not your strategy. It's not your risk-reward ratio. It's not even your lack of discipline, although that's a part of it. It's your entire perception of what smart money even is. You think it's about secret zones and magical indicators. You think if you just mark up the right breaker block, you'll unlock the holy grail. But smart money trading isn't about the where, it's about the why. Why is price moving that way? Why are traders entering there? Why are stops clustered at that level? Why does the market suddenly reverse right after retail gets excited? That's what you need to study. That's the mindset you need to develop, because smart money isn't just about structure, it's about intent. It's about understanding the market as a battlefield of beliefs, expectations, and emotional reactions. And right now, you're walking onto that battlefield completely unarmed. So before we go any deeper, ask yourself, are you really trading like the banks, or are you just trading like everyone else, pretending you're in the know? Because if you don't answer that question honestly, everything else is just noise. And noise is exactly what the smart money wants you to listen to, while they slip in quietly and take everything you left on the table. Chapter 2. Decoding the Bank's Playbook. You slide open your trading platform, the familiar hum of data appears, and you're ready. But instead of looking for juicy chart formations, ask yourself, what are the banks doing? Because they don't follow charts, they create them. They start with clean liquidity pools. You see an order block as just a rectangle, cut and dried. But banks see a cluster of pending stops, clustered retail entry, and an emotional threshold ready to snap. Their goal? Trigger that emotional pull and scoop liquidity while everyone else panics. And they do it quietly. There's no flashy breakout flagged in a tutorial. They let price move into the retail zone, let people pile on, then pull the rug. That shakeout you've heard about? That's not noise. It's the banks preparing their buy or sell. They don't measure risk-reward like you do. They measure exposure to emotional price reactions. They calculate where panic sets in and where greed peaks. Trading like banks means you anticipate that behavior, not by memorizing patterns, but by studying the flow of participant mistakes. Every failed breakout, every retest, every false validation, they're signposts. The banks use them to structure moves. First induce, then pause, then capture. It's a clean move, not emotional, controlled, surgical. Your job? Learn to see the setup as they designed it. The sweep of stops, the order block left behind, the mitigation candle. But more importantly, the sentiment behind them. The air of fear before the reversal. The sudden surge of volume right at key levels. This takes more than technical analysis. You need to overlay behavioral analysis on top of price. Ask, who is trapped right now? Where are emotional price thresholds? When will momentum fade? How far can this liquidity sweep go before banks pause? And if you're truly replicating a bank's method, you'll let price come to you. You won't chase the breakout. You'll wait for retracement, for clear imbalance, for clear liquidity clusters. Then you enter with conviction because you know the desire behind that move and the desperation behind every stop loss waiting to be hit. Let's take an example. Price pushes above structure. Retail sees green candles, jumps in. The banks hold. Price slides back in, trapping the late entries. Liquidity is consumed. And then the reversal. Banks move hard in the opposite direction, riding the surge of triggered stops. A bank wouldn't chase the breakout, they'd use it. The retail FOMO break becomes their ladder. And they don't stay in the trap. They go straight for the liquidity left over, contained, clean, predictable. But you often get whipsawed, too early, too late, emotional, fear-driven. You see the break, you jump, you get stopped. Meanwhile, volume spikes where your stop-loss evaporates into thin air. So start practicing this. Watch for momentary expansion in volatility, especially when it's fueled by a mass of stops. Recognize when retail participation spikes. That widening spread, that shallow retrace is not momentum, it's emotional inertia. Let the impulse die. Wait. Enter once clarity returns, ideally on a backtest into the order block or liquidity zone. That's how the banks structure flow, and you need to mirror that discipline, not the impulse. But most importantly, you need to watch two things. Behavioral exhaustion, when the emotional crowd has overextended, and institutional flow, when you can sense real pressure from large executed orders, not just retail volume. You may not have the institutional tape, but you can infer it. Watch volume spikes, watch rapid wick rejections, watch price hacks beyond the range that snap back quickly. This is your edge, the inside view you build from studying reactions. If you're in sync with that, you trade after the banks act, not alongside the immediate chaos. Because they don't start a move at the breakout. They start it when everyone else is already caught off guard. Now take a breath. Let that sink in. The banks trade with surgical calm. Not because they're smarter, they're simply unemotional. And if you want to be like them, you have to trade the impulse, not the signal. You have to become the watcher, not the reactor. Are you ready to think like this, or are you still waiting for price to prove itself? Chapter 3. Emotional Liquidity, the hidden currency of the market. There's a kind of currency most traders never talk about. It's not dollars, it's not pips, it's not even liquidity in the traditional sense. It's emotional liquidity. Every stop loss, every panic entry, every FOMO chase, it's all emotion. And that emotion, that's what banks trade. You see, price doesn't move just because of supply and demand. It moves because of fear, greed, doubt, and conviction. And guess what? The banks know that. They count on it. Because the more emotionally committed you are to your position, the easier it is to manipulate you. Ever notice how the market seems to target your stop loss like a sniper? That's not an accident. That's precision. The market isn't just moving, it's hunting. And who's the prey? Anyone who trades emotionally. Anyone who panics on a pullback. Anyone who chases a candle after 3 confirmations. Anyone who thinks a green candle equals safety. Let's be real. How many times have you felt it? You finally find the perfect entry. All your rules line up, price taps into your zone, boom, you're in. And then, price dips. You wait. It dips more. Your heart starts pounding, you're sweating, the candles are moving against you, and your brain is screaming, get out, protect yourself, cut the loss. You close the trade. And what happens next? Price reverses, explodes in your direction, leaves you behind. Again. You're not unlucky. You're not cursed. You're emotional. And the banks? They love that. Because they don't need to predict the market. They just need to predict you. They know where the fear is. They know when conviction turns to doubt. They know how to push just far enough to make you give up, so they can scoop your exit as entry. That's emotional liquidity. And if you don't understand it, you'll keep feeding it. Here's what most retail traders get wrong. They think price is the truth. It's not. Price is the lie. Reaction is the truth. Price is the story the market tells to trigger your emotions, to see who's committed, who's weak, who's greedy, who's scared. But reaction, that's where the real game begins. That's where smart money steps in. Because they don't see a green candle as an entry. They see it as bait. They don't see a liquidity sweep as a confirmation. They see it as a test. They don't trade the move. They trade the reaction to the move. They wait for the panic. They wait for the disbelief. They wait for you to give up, so they can step in. If you want to trade like the banks, you need to stop reacting and start studying reaction. What happens after a sweep? Do buyers jump in too quickly? Do sellers get trapped? Does price pause or accelerate? Where's the emotional pressure? That's where the banks strike. That's where precision comes in. Not in guessing direction, but in identifying where emotion is at its peak and then doing the opposite. And this is why most traders fail. Not because they're stupid, not because they don't study enough, but because they're emotionally tied to every move. They believe price has to respect their levels. They believe they're aligned with smart money because they drew a box on a chart. They believe they're patient until price moves against them by 10 pips. But banks aren't playing that game. They're playing the long game. They don't need 5 wins in a row. They just need to be in when the herd is out. So how do you start seeing like them? You slow down. You study the reaction, not the move. You ask, was this move emotional or was it calculated? Who just got trapped? What would cause most traders to hesitate right now? And can I capitalize on that hesitation? You see, the market isn't driven by patterns. It's driven by pain. And your job? Become the one who observes pain, not the one who feels it. Let others rush in on breakouts. Let them over-leverage on perfect order blocks. Let them scream at their screens when price does the opposite of what they expect. You sit. You study. You strike. Chapter 4. Patience, Precision, and the Psychology of Waiting. Let's talk about something nobody wants to hear, but every profitable trader lives by. Waiting. You don't trade like the banks until you wait like them. And not just wait, but wait with intent. Wait with discipline. Wait without falling apart. Because let's be honest, most of your losses don't come from bad trades. They come from early trades, premature entries, rushed setups, half-formed ideas you convinced yourself were valid because you were tired of waiting. That's not strategy. That's impatience masquerading as confidence. And smart money? They can smell it from a mile away. They wait, not because they're slow, but because they're snipers. They don't spray the market with trades hoping one lands. They hold, they stalk, they calculate. And when the shot presents itself, clean, vulnerable, unprotected, they take it with zero hesitation. Can you say the same? Can you watch a setup form for hours and still not pull the trigger because it hasn't reached your level? Can you wait through a volatile session without getting pulled into the emotion? Can you accept that most of your edge isn't in your entries, but in your ability to not enter at all? That's where trading like the banks begins, when you stop trading from need and start trading from clarity. The market is constantly luring you with opportunities that are almost good enough. But almost is how you lose money. Almost is how you get tapped in early, stopped out, and then watch price hit your original target without you. And that feeling, that I was right but still lost pain, that's the market punishing your impatience, not your analysis, not your bias, your lack of patience. Let me be blunt. If you can't wait, you can't win. Because smart money doesn't care if you get bored. They don't care if you feel like you need to make something happen today. They will bleed the market dry while you force setups that don't exist. They don't chase. They trap those who do. And if you want to join them, you need to start filtering harder. You need to raise your standards. Stop trading what's available and start trading only what's aligned with liquidity, with context, with behavioral exhaustion. Not every sweep is valid. Not every order block holds weight. Not every shift in structure is an opportunity. Sometimes it's a trap, and the banks are betting on you being too eager to see it. But here's the real shift, the psychological pivot you must make. Start enjoying the wait, because waiting is where your power lives. The silence before the move, that's where the real traders make their money, not in the chaos, in the patience before the chaos. That's when your vision sharpens. That's when your discipline gets forged. That's when the market starts to show its hand. And if you can watch all that unfold without reacting, you're no longer retail. You're no longer part of the herd. You've crossed over. You're hunting, not hoping. So here's a challenge. Go a full session without entering. Watch price, track the liquidity, study the reactions, mark the zones, feel the urge to click buy or sell, then deny it. Do it on purpose, because when you control your impulse to act, you finally start to see. You see where price really wants to go, not just where it is now. You see where retail is trapped and where smart money is about to strike. You see setups unfolding slowly, patiently, like a lion stalking prey. And when it's time, you execute without hesitation. No FOMO, no revenge, no doubt. Because the trade didn't come from need, it came from alignment. You were watching the market, not trying to force it. And that shift, that's everything. Because trading like the banks doesn't just mean understanding structure. It means becoming disciplined enough to wait until the setup begs you to take it. Not because you're bored, not because you're overdue, but because all the stars align. The liquidity is swept, the reaction is clean, the imbalance is present, and the herd is on the wrong side of the move. That's when you strike. That's when you're no longer just another trader. That's when you become smart money. Chapter 5. The Mirror. Why the Market Reflects You. Here's a truth no one wants to say out loud. The market is a mirror. And it doesn't reflect your strategy. It reflects you. It shows you exactly who you are, moment by moment, every fear, every hesitation, every desperate click to just break even, every trade you know you shouldn't take, but take anyway. The chart becomes a journal of your psychology. And if you look closely enough, you'll see the patterns aren't just in price, they're in your behavior. So ask yourself, when you enter a trade, are you calm, focused, or slightly panicked, chasing after confirmation? When you're in drawdown, do you accept the risk you planned, or do you stare at the screen, second-guessing yourself, promising to never do this again if it just turns around? When you win, do you feel clear, or do you feel relief? Because relief is not the emotion of a professional. Relief means you escaped. Relief means you weren't in control. And that's the truth. Most traders are not in control. They're reacting, not to the market, but to their own internal chaos. That's where the smart money difference begins. It's not the tool set. You can use the same charting platform, draw the same zones, mark the same breaks in structure. But unless you address the person behind the screen, you'll always be a few steps behind. Smart money doesn't panic. They don't jump in late. They don't average down in fear. They don't spend hours tweaking entries on backtests because they missed the point of why the trade worked in the first place. They understand this. Price is psychology visualized. Every candle is a decision. Every wick is hesitation. Every consolidation is indecision, traders fighting themselves. Every breakout is belief. Every fakeout is doubt. And that means when you look at the chart, you're not just reading price, you're reading people. And people are predictable when they're emotional. You've seen it. A clean level breaks, people pile in. Stops are tight, hopes are high. And then, wham! A quick reversal. Liquidity swept, sentiment crushed. The pattern repeats again and again. You think it's the chart, but it's the trader. It's you. Because the market reflects your state of mind. If you're desperate, it gives you just enough to bait you and then takes it away. If you're arrogant, it humbles you fast. If you're fearful, it forces you to watch what could have been. So how do you break free? You stop trading to prove something. You stop trying to catch every move. You stop looking for certainty where none exists, and you start asking better questions. What is the market trying to get me to feel right now? Whose pain is being created in this moment? What belief is being manipulated here? Because when you stop thinking in terms of setups and start thinking in terms of sentiment, everything changes. That's the secret of smart money. Not special knowledge, but emotional detachment. They let others panic. They let others overreact. And then they step in, calm, decisive, focused, not on price, but on what price is causing people to feel. That's where the edge lives. Not in the chart, but in the crowd. And if you want to see what smart money sees, you have to become the observer, not the participant. That means less trading, more thinking, less marking up charts with 100 lines, more watching how price responds at key levels, less need to be in a trade, more clarity about why you should or shouldn't enter. The chart is not your battleground, it's your mirror. And the question is, do you like what it's showing you? Because until you fix what's behind the trades, your mindset, your emotions, your relationship to risk, no strategy will ever save you. And that's not a bad thing. That's freedom. Because once you realize the market is simply reflecting you, you can change you. You can fix your process. You can trade less, but with more purpose. You can stop getting dragged around by noise and start waiting for real opportunity. And that's when everything begins to shift, not just in your results, but in your identity. You're no longer trying to be smart money, you're becoming it. Chapter 6.
Becoming the smart money. So now we've arrived at the heart of it. After all the structure, all the psychology, all the pain and lessons and stops and emotions, what does it really mean to trade like the banks? Here's the truth. It's not a strategy. It's an identity. You don't use smart money concepts. You become the kind of trader those concepts represent. Smart, calculated, patient, ruthless when needed, silent in observation, precise in execution. You don't chase the market. You let it come to you. You don't trade to win. You trade to participate in asymmetric opportunity. You don't seek comfort. You seek control. You don't fear drawdown. You understand it's a cost of positioning. And most importantly, you don't hope. Because hope is not a strategy. You've seen it, haven't you? Hope kicks in after the entry was impulsive. Hope rises when the trade starts bleeding. Hope convinces you to move stops, to average down, to just wait a little longer. But smart money doesn't hope. They prepare. They set conditions. And if the market doesn't deliver those conditions, they do nothing. Nothing. That's what separates the real traders from the pretenders. The willingness to do nothing when the conditions aren't right. Because smart money isn't chasing trades, they're stalking behavior. And now, so are you. You know what it means to wait for the sweep, to observe the reaction, not just the move, to understand that price is a byproduct of human nature, of psychology, risk tolerance, greed, fear, and pain thresholds. You understand that liquidity isn't just a cluster of orders, it's an emotional footprint. It's where retail feels most certain and where smart money gets paid. You've stopped trading price. You've started trading belief. That's the shift. That's the elevation. That's what it means to truly trade like the banks. But don't think this is the end of the path. No, this is where it begins. Because now you have to prove it to yourself. No more excuses. No more blaming the strategy. No more the market manipulated me. If you got manipulated, it means you didn't understand the game well enough yet. That's all. So study. Journal the reactions, not just the trades. Break down your emotions, not just your entries. Ask why a trade worked, not how. Understand how your psychology was played, not just how price moved. Every losing trade is a message. Every win is just a temporary moment of alignment. Neither define you. What defines you is the standard you operate at. Because smart money trading isn't about secret zones. It's about professional behavior, consistency, emotional neutrality, focused aggression, and clarity. That's what they have, and that's what you can have if you stop trying to trade like smart money and start becoming smart money. So let me ask you again, really ask you now that we've walked this entire path together. Are you really trading like the banks? Or have you just been copying the surface without becoming the substance? Because this journey isn't about technical mastery. It's about mastering yourself. And once you do that, you'll see it. The fake-outs won't scare you. The sweeps won't surprise you. The traps won't catch you. You'll sit, still, composed, while the herd runs wild. And when the market finally tips its hand, when the pain becomes too obvious, when the trap is set just right, you'll step in. Not with fear, not with hesitation, but with the quiet confidence of a trader who's done the work. Because now, you don't need to trade like the banks. You are the banks. Conclusion. Let's come full circle. After walking through the traps, the emotions, the fake confidence, the impulsive entries, after dissecting how banks see the market, not just as price, but as psychological reaction, let me ask you again, are you really trading like the banks? Or have you been lying to yourself? Because smart money doesn't chase. They don't overtrade. They don't enter out of boredom or revenge. They don't react to price. They react to behavior. They wait, observe, and strike only when the setup aligns with deep liquidity, clean structure, and maximum emotional vulnerability in the market. And now you know what that looks like. You know how the trap is set. You know how the sweep happens. You know how the reaction, not the move, reveals the truth. You know that price is just a map of mass psychology. And if you understand people, you understand price. But even more important, you've looked in the mirror. You've seen how your emotions, fear, greed, urgency, doubt, have shaped your trades. And maybe, for the first time, you've realized it was never about learning more setups. It was about learning yourself. And once you control that, once you develop the patience, the discipline, the detachment to wait for real opportunity, that's when you stop chasing smart money. You start becoming it. You think deeper. You move slower. You strike cleaner. You don't get trapped. You observe the trap being set, and you smile. Because now, you're on the right side of the pain. And that's power. Now listen, this transformation won't happen overnight. You'll still be tested, still get emotional, still fall into old habits. But the difference? Now you'll see it. And that awareness, that's your weapon. So here's what you need to do next. Subscribe to this channel if you haven't already, because this is the kind of content that's not here to entertain you. It's here to evolve you. Like this video if it hit home. If you had a moment of truth anywhere in this series, smash that like button. Let's flood the algorithm with real content for real traders. And finally, drop a comment. What was your biggest realization from this journey? What do you see differently now? And what's the one thing you're going to change about how you trade tomorrow? I want to hear from you. I want to see your growth. I want to know you're done pretending. Because retail is crowded. But the path to smart money? That's a lonely one. And that's exactly why we're building this space. For traders who aren't afraid to dig deep. Thank you for being part of this. And remember, the market will always test your emotions, but only the disciplined will profit from them. Now go back to your chart and watch it with new eyes. Because now, you are smart money.